Hello and welcome to the FrontierView's webinar, Russia CIS Outlook for 2021. I'm Zainab Kusadeh-Solo, Director for Middle East Africa and Turkey Research. Before we get started, we realize that some of you may be new to FrontierView, so we'd like to take a minute or so to provide you with a very quick overview of our firm and how we work with executives at major multinational companies. FrontierView provides the world's best market intelligence and advisory services for global business professionals. We help our clients grow and win in their most important markets by informing and powering their market monitoring, planning, execution, and other critical decision-making processes. With continuous research and insights, custom solutions, and transaction support services, we provide our clients a small sample of which you can see here, with timely, actionable insights to adapt and win in changing markets. If you are not a client and are interested in receiving a 60-day complimentary access to our FrontierView program, please leave a comment in the chat box or email us at info@frontierview.com. As part of our offering, we're excited to announce that we have recently launched a new mobile app, FrontierView Mobile, which is available on both iOS and Android. Includes all the relevant content you need to monitor markets, including this webinar recording and presentation deck. We encourage you to download the app to have access to these insights and more at your fingertips. As the research team here at FrontierView, we're excited to be sharing our updates with you through here. Current clients can access the mobile app using the same login information as our browser application. And if you're not a client, you can still download the app and start monitoring up to 5 complementary countries and access other features like daily news and notifications. So having very quickly and briefly introduced our company, I'd like to take a moment to introduce our presenter. Today, FrontierView's Director for Europe and Russia CIS Research, Mark McNamee, will be leading the presentation. If there are any insights you see today as part of this discussion or any questions we don't get to answer, our client services team will be happy to follow up with you directly. And so with that, I'll turn it over to Mark to take us through the agenda.
Great. Thank you, Zainab. So looking at the agenda for today, we have roughly an hour, and we'll leave some time, of course, at the end for questions. And please, as a reminder, type in your questions so that we can remember to ask them at the end of the presentation today. We'll be doing a review of Russia CIS 2021 Outlook for this year, which, to be perfectly honest, has always, for the last several months, has looked quite positive, but in the last 2 to 3 months in particular, has notably improved. So I'm happy to share all of our updated revisions to our forecast and outlook today. So we'll go over the global outlook as usual, issues United States, dollar, European Union, oil prices, et cetera, and then we'll dig a little bit deeper, specifically more into the region itself, Russia CIS as a whole, and the factors impacting growth in each country. And market dynamics. Then we'll look more specifically at the Russia outlook, where we'll spend more of the time naturally. And then we'll leave about 10 minutes or so at the end to look more deeply at CIS outlook, specifically Kazakhstan, Ukraine, Azerbaijan, and Uzbekistan. So with that said, as mentioned, Russia CIS is set up for quite solid beginning of the year here, and particularly relative to most other major regional economies around the world, which in turn should set up for a solid second half of the year. Naturally, there's risks to the outlook as we're emerging from COVID here, but so far so good. In particular, Russia and CIS markets managed this winter wave of COVID better than most emerging market regions, globally speaking, and particularly compared to Western and even Central European countries, which is creating more optimism in the market. Energy prices also being, frankly, a little bit higher than where they should be, but nonetheless, it's positive for the region, of course, so they're happy to have these prices where they are, is, of course, helping currencies and helping government revenues and helping general business sentiment across these markets. And as a result, in part because of the higher energy prices, currencies are also, relatively speaking, a bit more resilient, though that also has a lot to do with dollar dynamics over the last about 6 months as well, which we'll discuss. Still, risks do remain, of course, which could disrupt these otherwise strong growth prospects that we expect for the next several months here. In particular, of course, relates to COVID and managing the pandemic, which of course relies on decreasing hospitalizations by increasing vaccine absorption, which is a question for each country, and we'll discuss that in turn as we talk about each country. And then political risks, not just for Russia, as we've seen, of course, with Navalny's return and arrest and the subsequent protests, but then also the upcoming, this is all occurring, of course, in advance of the upcoming September Duma elections. And that's, of course, on top of the issues in Belarus that we've seen since last August. Ukraine is likely to see some political risks rising in the coming months, as kind of typical of Ukraine's political history. So some of these dynamics will impact markets the rest of this year. So again, starting at sort of the global level here, and then we'll dive down. We'll start with where the world is with COVID. So the commodity prices and global economic sentiment has actually boosted the last couple of months, and it has a lot to do with the fact that vaccines were approved in major markets around the world, and then people or countries started to implement these jabs, and vaccine absorption started to pick up. Now it's varied quite dramatically. You can see some of the countries here. UK actually has been, within the Western world, one of the fastest to be implementing. Over 12 million doses now administered as of this week. You can see here, Russia's a little bit behind based upon the latest government revealed information, but nonetheless, the campaign is starting to pick up a bit. US campaign is also starting to pick up a bit as well. So this has actually sustained some global sentiment for global economic sentiment, which is positive. But these campaigns need to start picking up more speed, as there are production and logistical issues that are preventing a faster vaccination absorption. You get an idea here, and of course I won't go over the entire world here, but you get an idea here in terms of reaching sort of herd immunity in most countries. What I'd highlight out of the Russia CIS region is that in Russia, this won't be until next year at some point. However, Western Russia should be pretty well vaccinated by the end of this year. So the major cities, of course, within Russia, in Western European Russia. Ukraine, though, might be a little bit more delayed, and this has a lot to do with the ability to obtain vaccines amid this scramble amongst European countries competing to get the vaccine, as we've seen in the press for the last couple of months. Related to just general global growth, a lot of course, revolves around one of the world's largest economic bodies in terms of the European Union. This will hold back commodity prices in the coming months. The fact that we're anticipating, as you can see here, we have quite high restrictions extending through the end of March. Restrictions likely coming off a bit around the Easter holiday season in April, but then having to be renewed again across most Western European markets, some Central European markets potentially as well, holding back European growth prospects for this year. That in turn would restrain some of that global demand for commodities, including energy, oil and gas. But nonetheless, we'll see massive improvements in the vaccination campaign across Western Europe and Central Europe in the second half of this year, which should then drive up stronger commodity price growth in the second half of the year then as a result. When we look at CEE at a, by comparison, relatively speaking, to most other markets, as mentioned, Central and Eastern Europe, so everything Poland throughout Central Europe and including Russia CIS, was more resilient than nearly all regional markets in 2020, and then it's also growing at a pretty solid pace as well. So more resilient in 2020 and bouncing back about as strong as most other regions, making CE quite popular when it comes to, of course, investment opportunities from the viewpoint of headquarters when they look around the world and consider where they should be placing their investments. The implication we've been hearing, particularly from consumer goods companies, is that this has actually placed a bit more pressure on Russia and CIS markets as well to be performing, to help maybe offset some of the weakness, compensate for example, the tourism reliant countries like Spain, like Italy, and other major markets in Western Europe that will continue to be quite weak throughout all of this year and into next year as well. Zainab, as you're on the line, any quick comments on Middle East and North Africa?
Of course, I think I can understand why there might be more attention on Central and Eastern Europe when you compare it with some of the dynamics in the Middle East region as well. Because of their reliance again on tourism and oil as well, last year they've been facing quite significant challenges. So as you can see, they're also entering a recovery period, but we think that a lot of the opportunities will be focused on the larger markets, Saudi, UAE, Egypt, Turkey, and not very kind of widespread in 2021. So can understand the increased attention going towards the Central Eastern Europe region.
Right. Thanks. And related to oil, also, Zeynep, I'd be interested to get your opinion and your viewpoint from OPEC and the Saudi view of things. But just to start and give our clients a perspective here, we have raised our oil price average forecast for this year. And this is based upon the quite high oil prices that have been really since about October, November now, and frankly more elevated than they should be, driven more by sentiment than actual supply and demand dynamics. So we've raised our oil price from $50 a barrel this year on average to be $56 a barrel, which of course is very, very positive for Russia CIS markets, where oil energy is such a critical part of government revenues. These prices should continue for most of this year, and as we've seen today, even oil prices went above $60 a barrel. And we should see this relatively consistent throughout this year and into next year as well. That said, a lot of this has more to do with sentiment, thanks to the OPEC cuts that have been implemented, and particularly by Saudi, as opposed to a clear revival in demand in the last several months, which means the oil prices are still quite fragile. Related to that then, Zeynep, do you have any comments from the Saudi view of things?
Of course, and I think I would want to underline that the prices today are, yes, as you said, quite fragile. We saw that Saudi Arabia was also quite worried about the slow pace of demand recovery that was clearly going to take place throughout winter and not match the original OPEC expectations for the demand recovery when they initially created the plans to gradually raise production. So in a way, it's not surprising that there was a need for production cuts, but it was surprising to see Saudi Arabia willing to do this quite unilaterally and also at this level. So they have been effective, as you said, to change sentiment, but at the same time to cause a gradual decline in oil inventories as well. But just a reminder, Saudi cannot maintain these cuts forever, so they'll be planning the optimal time and pace, gradually increase production. That's where we want to watch. As you said, this is very fragile. The balance of how quickly they bring back production relative to how quickly demand is picking up, especially in Q2, will be a very, very delicate one to really manage. So either we can see if they do this too late, prices shoot up to 70, that's too much volatility. If they do this too soon, then maybe prices fall back to 50. That range of volatility is too scary for any oil exporter, I think. So we have to watch very carefully in Q2.
Right. And I think that's an important point, is all the producers are eager to avoid volatility. So not too high nor not too low. But the important point for the CIS markets is that Russia, Azerbaijan, Kazakhstan, all of these countries, their budgets are based on oil prices well below $50 a barrel. In which case, all of this is just extra money that allows these governments, in particular, to help increase social spending, which we're anticipating this year, which will, of course, be very positive for consumer goods companies, as well as B2B companies, naturally. Related to the dollar, and I put this slide in here about dollar expectations for a couple of reasons. One is because the most common question I've gotten from clients over the last about 4 months has been related to currencies, for no surprising reason. But then also, the dollar has been performing, frankly, rather strangely. And now we're presenting this slide here to try to help explain why this has been going on. So as you can see here, what we're showing here is the dollar index, so the dollar strength against major currencies globally, against the blue line, which is growth expectations of the U.S. economy versus the other major economies of the world. Typically, there had been a solid correlation between these two, but then we've seen over the last several months sort of this movement away from each other. The idea is that they should return. It's a matter of when. Okay, our expectation is that this should have occurred already, but it has not, which means the dollar is weaker than where it frankly should be. We should see improvements, particularly as the U.S. economy starts to improve, as it is already, and the U.S. economy is going to be far ahead of Western European economies this year. So we should see dollar improvements, but we're not going to see dollar strengthening back to where it was, say, a year ago or 2 years ago. So improvements, but then stabilization over time. So our expectation is that this would occur by the second half of the year, which means we should see dollar strengthening against most of our Russia CIS currencies, but then a general stabilization ideally after that. More specifically, you can see the performance of the currencies in question here today. You can see the Russian ruble, the Kazakh tenge, a number of these currencies had weakened over the course of the summer of 2020, but then have actually stabilized, mostly due, not because necessarily of strength of these currencies, a lot of it had to do with dollar weakness. But now stronger oil prices are of course helping these currencies as well, the tenge in particular. And you can see our forecast just very quickly here. Minimal depreciation expected for 2021 compared to 2020. So again, for the reasons I mentioned related to the dollar, related to oil price improvements, I'll talk about sanctions in a minute on the ruble and the impact on other CIS currencies. But we'll see minimal depreciation on average from the current rate going forward for most of these currencies. So nothing to fundamentally disrupt demand or fundamentally drive up inflation in these markets. Our bias for the hryvnia, actually, hryvnia has been performing very strongly, is the hryvnia could start to appreciate, frankly, or it has appreciated considerably from its over the last couple of months, and that could actually maintain for the year. So we may actually strengthen our forecast for the hryvnia, and the som is still on a downward gradual trajectory. When we look at the region in terms of getting back to where we were in 2019 before the corona crisis occurred, again, Russia CIS markets really stand out in being ahead of most major markets across EMEA. You can see Uzbekistan never even had a contraction in 2020. Kazakhstan, Ukraine should be fully back by the end of this year. And Russia, Azerbaijan, probably about middle of next year. So this is far ahead of most other regions, and also your bosses at headquarters are viewing this as well and know this as well. So this could incur a little bit more pressure than for these markets to perform. So moving a bit away then from the strict economic implications, but then talking about COVID and structural implications, as opposed to the temporary COVID impacts in 2020 and into this year, what structurally is going to be changed about the market. So I won't go over everything here. I would highlight, if you look at the far right, the structural increases in certain sectors. So no terrible surprise, IT, communications, logistics, the whole digital environment, naturally, automation is here to stay, and that is a structural rapid increase that will continue going forward for years. If you look at the far left, the structural decline, what I would raise in particular is the decline in business travel, which will be permanent. It's simply a question of how much of a decline. And not only does that impact, of course, how you operate internally, as likely everyone on this call will be doing less business travel as well, and then how you compensate for that by a more digital interaction. But then also what that means for consumer goods companies, and then down the chain for B2B firms as well, because you will see less business travel. So that's just simply less travelers in itself. But then also, historically, business travelers have paid higher rates for flights, compensating them for a lot of pleasure or leisure travelers, so just more natural tourists. As a result, we could see structurally a bit higher prices now that there's less business travel going on, which in turn, if we're going to see higher prices for flights, could actually deter to an extent in the coming years pleasure travel as well. So something to pay attention to, particularly for consumer goods companies that are so, of course, focused on tourism in these markets. Also, we've taken polling across our client base. As you can see, no terrible surprise. When they're looking at investment priorities in this post-COVID environment, it's about e-commerce and it's about restructuring route to market, and restructuring route to market oftentimes does mean e-commerce focus. So the focus is digital marketing, internal digital transformation, external e-commerce partners that you're working with and how you work with them. No terrible surprise there. And then in terms of execution, what we've seen and heard, and again, this is across B2C firms, but B2B firms, healthcare firms, et cetera. We've seen, obviously, 2020 was a year of reaction, and then now there's more pressure, right? Companies, headquarters want more than a 3-month or a 6-month plan, so now they want more of a medium-term view and finding opportunities, not just simply putting out fires, of course. This naturally involves more scenario planning, okay? So what are the likelihoods of certain scenarios coming to fruition? What are the signposts to be monitoring? And these are all things that we've helped clients with considerably over the last year, and please reach out to us if you feel we could help you, of course, this year with that. Naturally, getting closer to clients. This is something that had been occurring for years, of course, over the last, prior to COVID. Getting closer, understanding your customers' nuanced needs and preferences, and attending to those. That was accelerated, like a lot of other executional tactics. That was accelerated considerably in 2020, and now this is something structurally which is here to stay and is going to be required more of multinational companies in these markets. The shifts in the channel, of course, so I won't go through everything, but no terrible surprise, the biggest focus of our clients is this digital internal transformation. And essentially the external environment, we're seeing these comprehensive overhauls of channel and this movement towards e-commerce that requires internally a comprehensive reaction internally to then address that external environment. So these are the types of things we've seen in Russia CIS, and this is frankly typical of a lot of emerging markets throughout EMEA of what we've been hearing. So countries were affected pretty similarly, and companies are responding quite similarly. I won't go over everything here, but in terms of commercial execution, probably the biggest thing is resegmenting customers now. Who are the most resilient? How are premium, super premium, luxury, upper middle class customers of yours? How are they reacting, and what is their demand resilience? How does that change your offering in terms of, say, package sizes or your marketing schemes? How to attract these customers again? So these types of things have become critical conversations over the last several months we're hearing from clients. So with all of that said, looking more at the region, CIS Russia region, we'll go over some of the high issues covering that impact not only Russia, but the entire region. First things first, of course, is that we have a new president in the United States, and this means a new foreign policy that will be a little bit more aggressive, frankly, towards Russia. Though that said, neither US nor Russia are looking for a fight, but we could see a little bit more hostility between the two sides because neither fears one either. So the expectation is that there shouldn't be really a formal fight between the two countries, but at the same time, a black swan event could happen, miscommunication could happen, anything could happen where we could see an uptick in at least hostility verbally, if nothing else, which would of course just damage relations further. Sanctions are coming, as Biden has promised repeatedly. It's a matter of what and when exactly. In the near term, most likely in light of Navalny's recent arrest and the protests, the Russian cyber hack unveiled last December, we'll see sanctions coming soon in the coming weeks against particular Russian officials, potentially oligarchs, in the near future. That itself should not cause too much ruble depreciation, if any, but it could come with more sanctions either this month or in the coming months as the US tries to align with the EU and the UK to try to combat dirty money and focus on more individuals and oligarchs, which would be a global sort of sanctions regime that the United States would be trying to implement around the world. So those could have some impact on the markets a little bit more potentially, similar to what happened in April 2018 when the US implemented sanctions against Oleg Deripaska, Viktor Vekselberg, and some others. But this is when we could also see sanctions against ruble-denominated debt, for example, primary issuances of Russian debt in international bond markets. So that also would have an impact on the ruble. So the expectation is we should see some ruble depreciation here in the coming months, but then general appreciation of the ruble in the second half of the year. And there are reasons for moderation, so we could see an even lighter sanctions regime than what I've just described. We have the Trump impeachment, of course, going on in the United States. It's beginning today, in fact. Russia also was not seen quite as disruptive in the 2020 elections as they were in the 2016 elections, plus the Democrats won in 2020 as opposed to losing in 2016. Biden does, of course, prefer to have a better working relationship with Russia and a collaborative relationship than not, particularly since they do want to talk about deeper strategic arms talk, particularly the International Nuclear Forces Treaty, trying to revive that. Plus, Biden wants to revive and improve relationship with the EU, which means they could be driving the Nord Stream 2 sanctions. So in terms of COVID now, moving away from sort of international politics, the very good news, again, unlike a lot of Western Europe and Central Europe for that matter, or a lot of the world, we have seen, as you can see quite clearly here, a flattening of the curve really across the entire region. So new cases and hospitalizations have slowed dramatically, particularly in Russia, the high bed capacity that was created after the first wave in April, so over about the course of 6 months in 2020, really did help protect the hospital system, and it never came under risk of being overwhelmed over the last several months. But that did put a lot of the burden onto the regions, unfortunately, and the regions have suffered much more. And a lot of, frankly, it's not even being shown up in the data, probably the extent of the suffering of the regions out east. But the R rate overall in Russia is under 1, even lower in Moscow, which is very good, which allows for obviously a removal of restrictions. But obviously everything depends ultimately on the success of the vaccination campaign. It is a little bit slow to date when it comes to Russia. It's unclear how many people have been vaccinated currently. The rough estimate is maybe 1 million people with the first dose of Sputnik. Now the goal, probably too ambitious and not likely to be achieved, would be 20 million by the end of this quarter, 70 million by the end of the year. In either case, the expectation is by this summer, so by we could say probably by at the latest the end of Q3, Western European Russia, the most vulnerable parts of the population, people over 60, would be widely vaccinated. So allowing for a clear recovery. And we don't anticipate new lockdowns either. So restrictions have been relaxed in Russia. They've also been relaxed in Ukraine, Kazakhstan to an extent. They've been quite low in Uzbekistan all along, and quite lower than Germany and Western European markets, which is of course very good, assisting demand in these markets. We will see another rise in cases naturally as restrictions are removed, but healthcare systems are not under terrible pressure. And culturally, there's more of an acceptance of the virus and a willingness to deal with it. And there isn't a lot of support. There's falling support for new lockdowns. So the expectation is that new lockdowns are quite unlikely going forward, but of course, monitor the vaccination drive here, particularly with new strains appearing and how successful how vaccines will be against future strains of the virus. You can see here also mobility trends have reversed and better than, say, Germany and Western European markets, which is of course very good. We should see a recovery back to pre-crisis levels by the end of this year at the latest in most of our core CIS markets, which of course will help drive demand. And you can see from our forecast here, quite solid resilience. Azerbaijan was relatively weak in light of obviously the war with Armenia in Q3 into Q4, but you can see the drops in Kazakhstan and in Russia were relatively mild and much better than consensus forecasts by the end of the year, and they've continued that resilience into the beginning of the year, so a solid outlook going forward. Uzbekistan, one of the strongest markets globally speaking. Very, very briefly on CIS markets. What we're showing here are exports to Russia as a percentage of all exports in the blue, dark blue color, and then in green, the remittances. In particular, Uzbekistan, as well as Armenia, their growth is quite reliant on Russia's revival. So currencies, of course, are highly correlated to Russia's, to the Russian ruble, but also the Russian economy's demand for exports from the region, as well as remittances going back, are quite critical. The good news is that Russia should be restoring growth, generally speaking, across the board, helping drive up remittances and exports to those markets. So with that said, we can now dive more deeply into Russia. As mentioned, signs of economic revival across the region have appeared, and in Russia in particular. Consumer confidence, business confidence are picking up. Also, the government is, for political reasons, particularly after these protests, and the fact that they have more money, are overhauling the national projects. And also, they just announced yesterday, there's a leak that Putin will be announcing a 500 billion ruble social spending program for 2021. Obviously, this is geared towards the elections, no surprise there, but all of this is going to help sustain and drive that pre-existing consumer and business confidence, which is of course very positive for the market. The vaccine administration has to pick up though. This is the primary risk, of course, in the next several months, but it seems that there's a lot of hesitance amongst the population to taking the vaccine, since it is widely available, at least in the major cities, and we're unfortunately not seeing that fast uptick. In either case, we do have there are some risks, particularly related to COVID and the vaccines, but we do view it as one of the most opportunistic markets across all of Europe and frankly across all of EMEA in 2021, but particularly in the coming months, as a lot of Europe will be struggling here throughout H1. starting off, of course, with the high-profile political topics here and what occurred here in the past month with Navalny's return, subsequent arrest, and then the resulting protests. Ultimately, we feel that it fundamentally will have a fairly positive impact, if anything, on the economic recovery. For one thing, we've likely seen this political response to Navalny's return and obviously the protests and what they represent with people's dissatisfaction with living standards, et cetera, that the government is now revamping the national projects, trying to speed up that spending, while also increasing social spending in the budget, plus this new announcement of social spending. All of that is going to help keep, basically, for political reasons, keep protesters off the streets, revive the economy, maintain support for a united Russia and for the Kremlin in particular. And then that's matched with, naturally, smarter repression. So not the type of repression we saw in Belarus last year, not what we saw in the Maidan in 2013 and 2014, but high enough level of pressure to remind protesters of the risk of going to the streets, but not too much to incur a significant backlash. In which case, the combination of those things should allow the government to have a successful September Duma elections. Yes, there'll be more protests between now and then and at the time of the elections, but nonetheless, we will likely see, if not a supermajority of United Russia in parliament, assuredly a majority in parliament in combination with maybe some smaller Kremlin-aligned parties. That said, what about Navalny, of course? What has been our view all along is that Navalny doesn't pose, of course, a existential crisis for Putin or the Kremlin, but he's trying to create, or at least initiate here, a long-term movement starting at this moment. So the threat isn't necessarily for the September Duma elections. It's way too early for that, most likely, but more long-term. So this does raise the risks for down the road, in 3 years from now, 3.5 years from now, the 2024 elections. But of course, it'll be difficult for him to maintain that momentum when he's behind prison bars, of course. So that'll be more of a long-term question. But the Duma elections are probably a little bit more in a better place. So the Kremlin feels in a decent place for the elections in September. As far as consumer sentiment then, so how do all these things impact? The political impact, of course, and ruble movements, oil prices, et cetera, et cetera. We have seen, because of the restrictions being relatively mild and now being taken off, incomes likely going up and expectations of incomes going up. We're seeing also greater labor market certainty in terms of employment. So unemployment fell to 5.9%. So that's 4 months of a consistent slowdown in unemployment. So hiring is picking up as well. And then consumer credit has been solid all along. Low interest rates, interest rates might go up minimally this year, but not too high. So we've seen, as you can see, in January, sentiment bouncing back to where it was last September. And September was a pretty solid month when it came to consumer spending. This should continue to improve going forward for all these reasons here. That said, inflation has started to pick up a bit, and we have the higher taxes on the wealthy. So particularly consumer goods companies selling to more premium segments, upper middle class, luxury segments. Those consumers are dealing with minimally higher taxes. Nothing dramatic, but that could limit some of their sentiment, of course. So our expectations are things will pick up gradually here. So a bit of an uptick in February, slightly better than January. January was actually, it seems probably a bit better than December, which is a very good sign because since about September, we really haven't seen a pickup. We've seen consistent falls in consumer spending. Incomes were quite weak, as you can see. Real incomes fell by 3.5% last year. Expectation is we'll see about 1 to 2% this year, and starting already now. So that's also very good. As businesses feel more comfortable reinvesting, consumer credit will remain quite high. So this is all very positive to see each month things picking up gradually. So the bigger worry would just be price sensitivity as consumers are coming back online and willing to buy products again. You can see here the ruble weakness accumulated over the course of 2020 started to impact price growth in Q4 and into January this year. And consumers noticed it. So the highest line here, the observed inflation, peaked nearly 13% is what consumers reported feeling that price growth was in January, and that's higher than in December, which was 12%, and higher than in November as well. So that keeps rising, and a lot of that is because of that ruble weakness and also food inflation in particular. Looking by categories, another reason we're fairly optimistic about things is because we've seen certain categories also picking up in January and in the first week of February here. So in particular, you can see here that appliances, electronics, some more durable goods have seen a consistent rebound since the slowdown in December. Across all categories, liquor as well, we've seen a pickup 2.6% for both of them into the first week of February. So that's very good to see already some of these improvements, which aligns, of course, with that revival in consumer sentiment that I just showed you. All the indicators point to this trend continuing going forward and improving considerably each month over the course of H1. Also, what we find to be quite encouraging is that savings have rose over the course of 2020, while debts also went down, which means consumers are waiting to get confident enough to really start spending considerably more. Okay, now 64% of consumers said that they intend to save money this year. This poll was taken at the end of last year. Our expectation is that sentiment will change, and they'll be more willing to be spending their savings when they feel more confident in the labor market, and the labor market is becoming a little bit more clear and certain, which should help then drive a lot of pent-up demand into the second half of this year, but likely even earlier, to be perfectly honest. So deposits of individuals, so savings levels in banks, hit a record volume in December at Sberbank. So this is all actually quite good news. Consumers' financial position has improved over the course of 2020, so we're just kind of waiting for that acceleration then of that spending. So sort of evaluating then how will consumers behave actually, right, a little bit more over the medium term into the long term. So towards the end of this year and into next year. Polling at the end of last year, and of course, take this with a grain of salt because sentiment does change over time naturally, but you can see here that some things basically will be permanent, right? So there's a different definitive preference for local brands to foreign brands. A lot of that has to do with price, of course, ruble weakness, but some of that will be here to stay. Some of that price sensitivity has become more accustomed to local brands. But then a little bit maybe more concerning and something to manage in your customer base and in your channel is the place, the occasion of consumption. So cafes, restaurants in the long term, 60% plan to go to cafes and restaurants, much less. Likewise, tourism, 70% will not be returning to previous travel spending for at least a year or ever. But 20% plan to increase domestic tourism instead for the long term. So they're keeping the money at least in Russia. And that's something we've seen. So kind of staying on travel here, Russia, and I know you probably don't feel this in the market, but as we've seen travel collapse around the world, but Russia was much more resilient than nearly every other major market in the world. To be honest, as the numbers you can see here, revenue per passenger kilometer growth for nearly all of last year only fell by 24%, and it worsened in October and November because of global restrictions going up, as well as restrictions in Russia itself. But compared to the rest of the world, this is actually much better. So that's something to consider. Zeynep, do you have any comments quickly on, because obviously a lot of Russians go to Turkey, go to Dubai. Any trends that you've seen with Russian travelers to there?
Of course, we've seen definitely a slow, but definitely an existing return of Russian tourists to Turkey over the last summer. Overall, we've had around 80% decline in tourist arrivals to Turkey, and the Russian arrival numbers also showed similar levels of declines, around 70%. But still, any of the pickup that the country saw definitely came quite significantly from Russia. We believe that Turkey and Dubai as well will try to be as open as possible to tourists throughout the summer, and will want to welcome Russian tourists as well, especially when you consider the currency dynamics towards Turkey. But after seeing some of the challenges that Dubai experienced in the last 2 months, with seeing a rise in numbers because of tourist arrivals, in terms of rise in COVID numbers, I think they will try to have more strict regulations, yes, for arrivals over the summer period, potentially more kind of monitoring of the PCR tests and potentially even vaccinations. But overall, we think that we'll probably see efforts to bring in tourists from Russia back into these countries.
Mm-hmm. Great, thank you for that. So moving from consumers then to particularly healthcare companies, but other firms selling to the government. It's important to understand that government spending dynamics have also improved considerably over the last several months. So firms selling directly to the government should be happy about that. But then also consumer goods companies and B2B firms, for that matter, should also be happy about this, because these higher energy prices and the political pressure, particularly because of these protests and Navalny's return, is going to encourage the government to spend more money than expected. So we just saw this yesterday, as mentioned, this 500 billion ruble spending program for this year, which will go to state employees, will go to supporting pensions, poor families, etc. But the plan itself, created in Q4 of last year, is quite conservative. So it does envision considerable amount of spending decline, as you can see here, by about 8%. However, most likely that is going to be much higher, because the Russian government, since 2016, in every single year, has put out a very austere conservative budget, and every single year has made ad hoc spending changes, sometimes 2 or 3, increasing spending over the course of the year when they felt comfortable with it, as oil prices were higher, revenues were stronger than expected, and then they're able to spend more money than planned. So that's very positive for the market. And then the national projects also, this has been leaked out as well, that they're going to be revamping the national projects. Spending was extremely slow last year, as obviously the political focus moved to COVID. So only 70% of the national projects spending plan was achieved through October. So obviously well below the 80+% that it should have been at. And you can see several categories. Digital economy in particular has been lagging 2019 and 2020, in fact, both of them. But all of these categories were lagging quite considerably. Now there's a considerable focus on revamping this. So the spending categories are now going to be reclassified, repackaged once again. This is becoming Prime Minister Mishustin's primary focus now for the next couple of years through 2024. A new social contract. So we're going to see direct payments. So massive hikes in social spending coming. Direct payments to the poor, as they define this, a new social contract. And then goals of greater digitalization, of course, focus on demographics, which has been there all along. Demographics actually got a very nice spending hike last year. And actually a lot of this money that was not fulfilled in 2020 is being carried over into 2021 and will likely be spent, particularly because of the political pressure with the elections looming. On the business side of things, we've also seen very strong improvements over the last several months, particularly because of the trade linkages to Asia. So that rising Asian demand helped drive, particularly for commodities, of course, helped drive a lot of the improvements. But also the domestic demand was critical in helping manufacturing recover and grow by 4.4% in December, which is quite surprising. Manufacturing for the year actually was resilient and was about stable for 2020. Again, better than most markets around EMEA, so quite positive. And then PMIs, so the business sentiment surveys, you can see also December and January improvements going forward, and critically for services PMI, so the dark blue column here, being above 50, which means expectation of rising orders in the coming months, which is very good, because that means people are going back to the service sector, going back to restaurants and cafes, et cetera, going back to legal services, accounting services, and driving growth there. I won't spend too much time on this, but I know clients love this slide, so I'm including it here for your reference. And as a reminder to everyone on the line, you will be getting this deck. But basically, you can see several. Basically, there's a moderate pickup. We're expecting one. There's a nice pickup in Q4, and that's expected to continue in the first half of this year, driven by light manufacturing, chemical sector, agriculture, construction, food processing, etc., which are very strong throughout 2020 and should continue to be quite solid. And very critically, oil and gas and mining are recovering, thanks to reviving global demand, particularly from Asia, which is driving up prices and therefore production and profitability of those companies. So those companies, for the B2B firms, should see some revived demand going forward. And again, I won't spend too much time here, but to get an idea from this chart, I've showed this to many of the clients on the line here today. In the past, the recovery sort of by industrial sector here. So when will we get back to, in orange, that pre-COVID level of demand? When will we be well above it? How long will we be below it for? So you can sort of see this for your own particular industry. I just would mention in particular, retail durables should be reviving here quite soon, frankly, getting back to probably pre-COVID levels here in the coming months. And if you look at the very bottom, hospitality, tourism, leisure, unfortunately, that will be restrained for the rest of this year at a minimum. So it'll take some time. Manufacturing, though, should also be coming back here in the next couple of months. We've already seen some growth in December. Obviously, we should see that some improvements then likely into the first half of this year. E-commerce naturally has been rising quite considerably, so this is a trend that is here to stay. No terrible surprise, but e-commerce as a percentage share of total retail accelerated well beyond expectations. These expectations prior to COVID, it was expected that e-commerce as a percentage of retail sales would hit 10 to 11% only in 2024. Because of COVID, it brought that up by about 3 years. So absolutely critical, just reconfirming the need to focus on internal digital transformation and those trends. As you can see, as mentioned, the ruble improved and then stabilized since last summer, which is positive, but a lot of this again has to do with dollar weakness. So plan for the ruble based upon your expectations for the dollar going forward. And then likewise, a lot of the growth of the economy will rely on the vaccine rollout. In either case, you see our forecast, which I shared with you earlier. You can see our forecast for GDP as well. So we've actually raised our forecast for 2021, particularly in light of this increased spending by the government that will help, plus the reviving consumer sentiment. And then in addition, we actually revised up a bit our 2020 forecast because Q4 was considerably stronger than anticipated as well. So again, all signs are really pointing to a quite solid year for Russia. And so appropriately, I wanted to share the Pushkin poem of winter morning. So Moroz i Solnce, Dien Chudesny. So for the non-Russian speakers, so frost and sunshine, a wonderful day. As this year is starting to look, and I know it's cold and been snowing in Moscow, but nonetheless, I think we can see clear improvements coming forward, both with the market and with the weather.
Thank you very much, Mark.
Yes.
For the updates on the demand trends in Russia. As a reminder to our listeners, FrontierView clients can reach out to their client services managers and request tailored briefings with Mark, where he can actually provide a lot more detailed updates. As a reminder, Mark, I believe you'll be happy to provide in-depth briefings on your kind of primary CIS markets aside from Russia as well, including Ukraine, Belarus, Kazakhstan, Azerbaijan, and Uzbekistan. So maybe we can have a quick round the region there as well.
Yep. Yeah, perfect. I'll be very brief. I did see a question here, so I will reply to that. One question came through saying why sustainable farming will increase. So sustainable farming has already increased really around the world, but and particularly in some developed markets, as a lot of consumers obviously being stuck at home, trying to maybe keep down costs, have been reinvigorated to focus on cooking and organic food and some of these things. So we've seen actually some more some home gardening and things like this. Some of these trends actually rising in developed markets, and then obviously in emerging markets because of the cost pressures implied by COVID. People's, for some people, their drops in income or loss of job. That's also encouraged more sustainable farming for emerging markets, as people are trying, of course, to cut costs and have the ability to be planting their own food. Zeynep, would you add anything to that you're seeing differently or in addition to that in your markets as far as sustainable farming? Okay, maybe we lost Zeynep. But in either case, I will move on to, and please, again, send questions along the way. We still have about 10 minutes left here. So I will go through this very quickly, but again, very positive news for the rest of CIS as well. So COVID is under control. We've gotten past those second waves. Consumer spending was very solid, particularly Ukraine, Kazakhstan, Uzbekistan, very solid in Q4, and it looks like that strength continued into the beginning of this year. Vaccination campaigns, Ukraine's under a little bit more pressure, unfortunately, more of a delay there. but it looks like, for example, Kazakhstan should see a revival, should see an uptick in vaccinations. Here, they procured Sputnik among some other vaccines, as developing their own vaccine as well within Kazakhstan. So we should see major cities in Kazakhstan, in particular, vaccinated really by this summer, so by the beginning of Q3, which means opening up, your core customers and core businesses you're selling to in the market. Government support is going to be actually better than expected. For the same reasons as Russia, the social spending is going to be increasing, budget revenues will be higher than expected in the budgets. All the business support measures, particularly in Kazakhstan and Uzbekistan, are going to continue throughout this year, social spending to continue as well. But we are seeing digitalization of the tax and customs system. When you look at Uzbekistan, where about 50% of the economy is estimated to be in the shadows, when you expect the shadow economy in Kazakhstan and Azerbaijan to be around 30 to 40%, they're trying to bring that income out of the shadows and trying to formalize it a bit more, which means greater tax burden on consumers and businesses in the country. But these high energy prices are absolutely excellent. So raising these energy prices will be absolutely critical to these recoveries, to these currencies, to greater government spending and support of the population, which is very good, particularly since labor markets and inflation are the primary risks. When you look at Kazakhstan, when you look at Azerbaijan, when you look at Uzbekistan, those labor markets are under considerable pressure because of the size of the shadow economies there. And so higher energy prices will help sustain these economies and then help, of course, maintain some of these incomes, and then inflation. So this should help with these currencies, so then you can keep down import prices, because inflation, particularly food inflation, is extremely high in a lot of these markets. The implication in terms of execution, now I know a lot of companies that we're speaking with here today are working on a distributor model in most of these countries. So the issue here is that negotiations with big retail partners are going to be quite critical, and the pressure on pricing, as we're seeing prices rise, we're seeing currencies depreciate, and we're seeing this consolidation in retail. It's gradual, it's been accelerated by COVID, but we've seen a clear consolidation of retail trade in Azerbaijan, in Uzbekistan, in Kazakhstan, in Ukraine, etc. Digitalization, of course, no different from the Russian market or elsewhere. So it just reinforces the need to use digital engagement with your key partners as much as possible. And then do you feel prepared in terms of inventories? There's a lot of pent-up demand in these countries. There's going to be a nice acceleration in growth. Our expectation, we've already seen that actually in Ukraine in Q4. Our expectation is that we'll see something like that in Kazakhstan. We're already seeing it to an extent in Uzbekistan. Similarly, we'll likely see that a little bit more delayed in Azerbaijan. So are your distributors and are your supply chains ready for that uptick? And then when you think about channel revival, so B2B firms, when you're thinking about the companies that you're selling to that will be opening up again after restrictions, people going back to cafes and restaurants, consumer goods companies ready for that channel to be revived again. When is that going to occur? How resilient will it be? So working with your local partners to understand better how those dynamics will play out, and they'll vary country by country, of course. Very briefly then, I've left slides on each of the 4 countries I mentioned at the end, but I won't have time to get to those. So I'll just stay at the higher level here. In terms of comparing the Russian market to the rest of CIS, so the primary markets I've mentioned. GDP growth will be solid in Russia, around 2.5% for this year. So if you look at the x-axis here, solid growth, which is a nice rebound after the last year's contraction. But if you take CIS markets, which is close to 4% growth, obviously that's quite considerable. Now the size of the bubble here, you can see the Russian economy is much larger, naturally, in US dollar terms, than all of CIS combined. That said, the point of what I want to show here is if you look at the y-axis, in US dollar terms, okay, the additional GDP this year compared to last year, yes, of course, and with Russia, we're getting about 50 billion more dollars in terms of GDP, thanks to this growth. However, CIS markets are bringing in about 30 themselves in total. My point here is that, particularly if there's going to be more pressure from corporate for the Russia CIS portfolio to perform and to help compensate potentially for other weaker markets elsewhere in the EMEA portfolio, CIS, and I've heard this from a number of particularly consumer goods companies, can serve as a very helpful sort of support system to boosting revenue across the entire portfolio. There's going to be a lot of competition, as we know, of course, in Moscow, in St. Petersburg, in the largest cities. And so how much gains could you get to sort of support your overall portfolio? Looking more specifically, same exact chart, but now dividing up the region. Do not ignore Uzbekistan. And I know it's a difficult place to operate. A lot of you are maybe new there or are not extended there yet. But you can see here that, yes, it's a much smaller economy overall, right? The bubble is much smaller compared to Ukraine or Kazakhstan. However, in the amount of US dollars it's bringing back, additionally, compared to 2020, is actually quite high. So maybe a good opportunity to be expanding, trying to build up market share and brand recognition in Uzbekistan with such nice rewards. Inflation is what you have to watch out for, though. So I'll just give these two last slides and we'll move on. But inflation is something to pay attention to, particularly in Kazakhstan. Uzbekistan doesn't report this data officially each month, but they're even higher than Kazakhstan. This is going to, of course, weigh on sentiment, contribute to a lot of price sensitivity, particularly since in most of these countries, food is about 50% of all consumer purchases, in which case that really does impact discretionary spending in these countries. The issue is that we've seen across all of Q4 for every single country, essentially, a continued significant uptick in food inflation in particular. And then government spending, as mentioned, these public deficits are lower than expected for 2020 across the board for nearly every country. And for next year, the plan is quite conservative, and most likely a lot of these governments will actually see nearly balanced budgets. Probably not Russia, probably not Kazakhstan, but Uzbekistan, Azerbaijan, maybe even Belarus potentially. So we're seeing higher social spending, protection of incomes, pensions, higher healthcare and education spending, et cetera. So all of this is quite positive for demand. So I'll leave it at that. As mentioned, we have slides on Ukraine, Azerbaijan, Kazakhstan, and Uzbekistan. So you'll have those available to you. But Zainab, anything else come through? I'll leave you with this nice view of this slide.
That's a very good slide to have here, I guess. One last question I think we have on the line before we end is why we expect a decrease in healthcare and medical tech as of second half of 2021. I believe this might have been referring to the slides you've shared in Russia around the sector's recovery pace.
Yeah, it's more of a slowdown. So the healthcare dynamics, of course, have been, whether it's pharma or med tech, med devices, have been, there's a lot of volatility expected because obviously the tremendous changes from COVID. So basically what we anticipate is a bit of a revival in focus on other healthcare sectors away from COVID in the coming months. So that could help then raise demand for med tech, medical devices, et cetera. But then it should also later on then moderate once again. Pharma was quite resilient, of course, throughout 2020 naturally, but then we'll see a bit of a dip going forward and then a revival after that. So it's kind of odd dynamics when it comes to the healthcare sector because we've had an odd year as it relates to healthcare, of course.
Got it. Thank you very much, Mark. I think we're at the time limit for today's webinar. If there were any questions that we were unable to answer on the line today, we will make sure to follow up with responses through your client services manager. Everyone will also receive a recording of the presentation within 24 hours. And you can view these webinar materials and much more on our new mobile app, as I've mentioned, which is available for download right now on iOS and Android. For complimentary access to our suite of resources, including data, dashboard tools, and market monitoring reports, please do email us at info@frontierview.com, and a member of our team will be in touch. Thank you everyone on the line for joining us, and we look forward to speaking with you again very soon.